Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Richard Hunter of Wilson King Investment Management.
Hi, Simon.
And Ben Kumar of Seven Investment Management.
Hi, Simon.
Welcome to the show, Ben. Now, we want to talk a little bit about stock markets. Are they expensive? The major markets around the world have had a pretty decent run of things in recent times. But do they now look expensive, do you think, Ben?
But it depends. On a relative basis, particularly the US and the UK, you keep hearing, you keep seeing they're at all-time highs. But guess what? Companies have never been more profitable than they have been now. Companies are making earnings at rates not seen before. But there are also places in the world like Europe, like emerging markets in Japan, where maybe those valuations are a little bit more attractive. Still got same big companies making money, but people are a little bit scared. The other thing you've got to think about is whether equities as a whole are expensive compared to where else you could be putting your money. If you look at government bond markets, the UK government recently issued a 40-year bond yielding 1.7%. Not very much for 40 years, guaranteeing you get 1.7%, and it was 5 times oversubscribed. So clearly people are desperate to put their money wherever they can, just to scrabble out that tiny little bit of yield. And you know why? Because bank accounts aren't paying you anything with interest rates where they are.
And going back to the basics of why we even asked the question, why does it matter if a stock market is expensive?
Well, lots of people have this idea that when stock markets, start getting expensive, then a big sell-off is coming just round the corner. The S&P 500 in the United States has been going up and hitting all-time highs for the past 3 years now. So it's not always true. If it's expensive without a bubble-like valuation, markets can get more expensive for a long, long time. That's why markets go up over time. What I think we're worried about, what people are still worried about, is that 2007, 2008 mentality of there's a bubble coming, if I can get out of the way, then I won't be hurt by it.
There also seems to be a lot of people saying that if we cast our minds back to the financial crisis of 2008, 9 years ago, it's been a while, and obviously markets have performed well. But the thing to remember, I think, is that bull markets don't die of old age. They die because something happens. And one of the concerns after the Trump euphoria towards the end of last year was that in terms of Q1 earnings coming through, companies had to keep their side of the bargain and prove that some of those valuations were justified in terms of earnings. And for the most part, they have done that. So that makes it quite difficult to make a comparison on valuation terms where the E part of the PE ratio is holding up.
And talking about that, actually, when we look at stock markets and we decide whether they are cheap, whether they are expensive, whether they're just fair to middling, how do you judge whether a market is expensive or not? We've got the price to earnings ratio, we've got the cyclically adjusted price to earnings ratio, we've got the price to book ratio. Is there any one of those that's better than the other, or is it you should be looking at the picture as a whole?
I'm a big fan of looking at the picture as a whole. You have to put it in context. So a price to earnings ratio of, 16, 17 times that the US is on at the moment looks historically expensive. But in the context of a world where companies are growing earnings at 5, 6, 7% a year, but like we say, government bonds are yielding 2%, actually, you do want to be paying more for those company earnings growing at that rate. When bonds were growing at 5% and companies were growing earnings at 5%, yeah, okay, you were probably a little bit indifferent between the two. Now, though, companies are genuinely offering you the chance for growth, while bonds aren't. They're not even keeping up with inflation. So when you look at the big picture, those earnings multiples may be the same as 8 years ago, maybe the same as 12, 15 years ago. But the world we're in is very different. And that's why even doing things like cyclically adjusting, averaging out over time, it doesn't tell you the whole story because the conditions today are different than we've ever seen.
And the other thing, of course, is particularly given low interest rates and what you can and can't get on your money, is the dividend yield. I mean, even in terms of the FTSE 100, let's say for argument's sake it's 4%, it's probably nearest 3.5%, but let's say it's 4%. That means in a year like we had last year, for example, you get a 6% return capital-wise and another 4% bump in terms of your dividend. That's 10% in what wasn't a massively spectacular year. And as we've spoken many times about on this show, if you start getting the compound effect of reinvesting those dividends as well, then you are going to wonder why you weren't in the market earlier when you got a 40-year bond on 1.7 or 0.002 or whatever it is in the bank account at the moment.
And the philosophy behind value investing is to look for things that are good value, that are cheap. I think most people can get a grasp on that. Now, obviously, there is the risk that if you do that, you end up buying something that's cheap because it's getting cheaper and it's about to go bust. But there is another philosophy that says there can be a time when you should pay a premium. Would you agree that there can be times when you should pay a premium for a market or a share, Richard?
Yeah, absolutely. And that one of the reasons you will find that, for example, if the market takes a 10% tumble, defensive shares will still go down, but they won't go down as much as 10%. Equally, if there's any sort of risk aversion going on, you'll usually find that defensive shares are trading at a premium for that very reason, that they're more able to withstand economic shocks, and then therefore you pay for that premium for peace of mind as much as anything else.
And from an investment point of view, that premium price argument is one that's been applied to the US market, hasn't it, in recent times, which by many of those measures, be it, PE, CAPE ratio, price to book, it's expensive. We've got on the Schiller PE ratio, which is also the CAPE ratio, we've had warnings for many years that basically it is at a level that it's only ever been higher at the peak of the sort of 1920s boom and the dot-com bubble, and neither of those ended particularly well. So a lot of people see that as a warning to get out of the market. An investor whose work I like to read, a guy called Ben Faber in the US, compares it to playing 21. You're at the blackjack table, you've got 19. Do you keep hitting it for more cards, or do you stick? However, one of the arguments put forward by those saying, no, don't worry about this, is that it's worth paying that premium price for the US because it's packed full of these companies that are premium price companies, the future stars, the tech stars, basically, the Facebooks of this world.
Yep.
Is that something that you guys buy into at the moment, or are you wary of the US?
At 7IM, we are more interested in the value side of US, like you say, those companies that do look a little bit out of favour, and trying to identify whether they are a value trap, whether they're going to keep on getting cheaper, is really important. But, if you want to be a US equity investor, you need to understand what's going on in Facebook and Google and Netflix and the FANG stocks, basically, because it's been very, very hard for any active investor or smart passive index or value index to beat the S&P 500. It's been very hard for the past 3 years because those stocks, you can look at whatever valuation metrics you want that tell you they're expensive, and you can write as many scared headlines as you like about how expensive they are, but they do keep going up, and they keep growing their revenues, and they keep growing their market share. So looking at them in terms of probably old school fundamental investing, price earnings, or even earnings and sales, it's not relevant for these new business models. And I don't think actually, and I would put myself in this category, I don't think the investment world's got a handle on that yet. It's not the same as when you just make so many widgets, how much does it cost you to make these widgets? Amazon came out as a online bookseller, and now it provides web services for like 30% of America. That's not something you could have foreseen if you bought Amazon at a premium 5-6 years ago. But if you trusted to their innovation, then you've been rewarded. How do you model innovation? I think it's really, really hard. And there's a big part of me that thinks we're turning into a world where people are basically putting their faith in individuals, in your Jeff Bezos, in your Mark Zuckerberg, in your Schmidt at Google, to keep reinventing and keep innovating. And it's really difficult. And then every time I say that, people say, well, now Steve Jobs left Apple, nothing will be the same for them again. Tim Cook's taken it on even further. There is a premium for innovation as well as defensive nature of companies, and paying it in the past 5 years has definitely been worth it.
And that's the thing, isn't it? Because the thing with the US tech stocks, which are for the most part, Alibaba aside maybe, pretty much leading the world, you've got to try and also think whether there's an element of fashion in there, and whether in 5 years' time Facebook will still be as popular. Probably applies a bit less to Apple because of the suite of products that they keep coming out with, quite apart from the cash pile they've got, which at
250 billion now?
$200 billion. I mean, they could probably help Greece out on their own, and a couple of other peripheral countries. So that's where the question mark comes, and that isn't because of that, as we've been saying, that's not because of the valuation per se, but that stock will continue to rise until something happens. And although that sounds very trite to say, one of those things could be fashion, as I say, maybe less for Apple, or something totally new that we don't know about comes out in the next 5 years, which blows the existing tech companies out of the water.
And I'd add one last thing, which is that if you look at a lot of US active managers now, you look at their portfolios, and whether they're value managers or whether they're growth managers or whether they're defensive managers, they're all trying to find reasons to sneak these tech companies in. Right? I say sneak, bit of an exaggeration, but if you go and see a value manager, he'll tell you why Apple, Google and Facebook are value stocks. If you go and see a growth manager, he'll tell you why they're growth stocks. If you see a defensive manager, he'll tell you why they're defensive stocks. We own a UK fund manager who has Apple in his portfolio because he says Apple sells a lot to the UK market. But absolutely it does, but I suspect you probably want it because it keeps going up every year after year after year. The justifications on value can go, a myriad of ways. People use what they can see to justify getting in.
And another interesting thing about tech stocks is that if you remember, there was a portion of the market which wasn't allowed to invest in Apple a couple of years back because Apple wasn't paying a dividend. Once they opened that gate, it let in a whole new swathe of investors. So again, a very successful tech stock not currently paying a dividend might be one to have a closer look at.
And one of those other things that makes it harder to decide whether to pay up for something that is at a premium is that once it's already had that big rise and it's already trading at a lofty valuation, you've got to make the decision where you can say, well, I can understand why it's risen up to this point, but can it keep doing that? So, for example, after the Facebook float, when the shares went up and then they sunk, it was much easier to get a handle on why it might be worth buying Facebook when it was beaten down 3 or 4 years ago. If you could understand that the reason why it was going to succeed is because of how well it could target its adverts, that it could get you person X who's done Y, who's done Z, who likes, A, and also, knows someone who likes B and C. If you could understand that and why people who spent £10 on an advert with Facebook got much more back than if they spent £10 elsewhere, and then you looked at it and went, well, it's a lot cheaper than it was, and I think there's plenty of growth here, then you could make a good case for it. Now, trying to do that same thing today when it's already made those easy gains, it's already pulled off that stuff, can it do it again? Can it keep growing that? That suddenly becomes a lot harder. So then, if we take that back to the sort of global stock market level, we start moving away from somewhere like the US and looking at other parts of the world, and other parts of the world where you're seeing better value at the moment, where it's almost worth saying, right, I know that's a premium, I know it's expensive, but maybe I should just be looking elsewhere because it's going to give me a better chance of succeeding.
Yeah, so a really interesting area to look is one Richard mentioned, Alibaba and the Chinese tech companies, in fact, Asian tech companies in general, right? Your analogies to your Facebooks and your Googles and your Apples. In Asia, they have the same return on equity, right? So they're making about the same level of profit for about the same level of expense. And they are trading on about 20% cheaper valuations. Now, they are still trading on expensive valuations relative to the rest of the market, but if you are buying similar companies exposed to similar demographics but in their own region for 20% cheaper, I think that's something worth investigating. And when you look at the Asian market in particular, it used to be thought of as a very cyclical market, right? It used to trade with the global cycle. When things were going well, Asia would do better than most of the rest of the world. When things are going badly, it gets hurt, because it was seen as the exporter to the world. Well, actually, 25% of the index is now in tech, and you've got another about 20% in financials. And those banks and those tech companies mainly focus on domestic Asia, which is kind of where you want to be. It's kind of where investors have been wanting to be for a long time, right? You've been hearing for ages people say, I want exposure to the Indian consumer or the Chinese consumer or the Korean consumer, whoever it is. So when you look at Asia and you see somewhere that might be resilient to a global cyclical recovery or indeed downturn again, and you think, right, and the valuation's cheaper, they've got a big domestic market. You draw a circle about 3,000 miles wide around India, and you have over half of the world's population in that circle. That seems like somewhere that's really interesting, given it's trading a lot cheaper than the US. You're not looking there, in Asia now particularly, for them to piggyback the US recovery anymore. You're looking at them to get a kicker from the US recovery, but to really focus on what's going on in their own market. And, it will take some time. These are not developed countries, but they are very, very exciting ones.
And one final question is, when you're looking at markets like that and you think, okay, well, you think that market as a whole, that looks good, do you guys at Seven think, right, we're going to go find an active manager to cherry pick the best from that market? Or do you think we're going to go passive and we're just going to use a tracker to get access to it? Or are there times when you would do one over the other?
Well, we do a bit of both, because we have one set of funds that has active managers, and we have one set of funds that does it via passive. And you can blend them if you like, but we will try and find active managers in areas where we think they can add value, where they can pick stocks, and Asia is certainly one of them. If you look at the US, though, both in our active product and our passive product, we don't have any active managers. Why? Well, none of them have beaten the benchmark in the past few years, and we think it's very, very difficult for active managers in large cap US to really make those active decisions. So you won't see any kind of active managers in the US. You won't see that many in places like Europe, in the large cap area. But in Asia, and actually in Japan, there is real opportunity for active. Japan in particular, because it's been a forgotten market by the West for so long, right? People have not had a Japanese allocation in their portfolios as kind of standard for maybe 15, 20 years. Now people are getting interested again. Those analysts, those fund managers who stuck out the last 20 years still know those companies, and they can really add value. Active managers in Japan are outperforming in the main, which is something you don't say about a lot of active managers.
Ben, that's all we've got time for. Thank you very much. Richard, thank you very much.
Pleasure.
Thank you very much for watching the Investing Show. Join us next time. Goodbye.